Today we have the pleasure of Roger Montgomery from Montgomery Funds Management. We invest a portion of our clients' portfolios that we manage in Montgomery Funds Management. Roger, we live in challenging times.
Sure.
Markets are fairly fully valued, they suggest, in the US. What do you do as far as your philosophy is concerned when you see markets pretty fully valued?
So you have two choices. You can buy your 35th best choice, or you can move to the safety of cash. And we're fortunate that when we built our business, we deliberately set out to preserve and protect clients' funds. And we thought the best way to do that is, if we can't find companies that meet our criteria for both quality and value, that the safest alternative is the safety of cash. So when markets are becoming expensive, you talk about that being challenging. It definitely is. It is challenging because momentum drives stock prices higher, but doesn't necessarily make the companies more valuable. And in those scenarios, we think that is challenging, but nevertheless, we prefer to have cash.
And Roger, throughout your career, if I can ask, what's been the best piece of investment advice you've received?
Well, it was advice that I experienced rather than received from someone, and that was to lose what at the time was a very large amount of money. I was only 18 and I lost $10,000 trading futures. That seemed like all the money in the world at the time. But of course, over time you make that back. And so it was a valuable lesson. Nothing teaches you risk like losing money. And that's, again, one of the reasons why we developed a framework and a philosophy that seeks to preserve and protect investors' funds. People need income, particularly in retirement when they haven't got an income source from their work. But if it's to the detriment of income growth, so if you chase a high yield today and don't consider whether the income is going to grow, then your purchasing power is going to be eroded in the future. So if we take the example of Telstra, and putting aside that they recently cut their dividend, if you imagine for a moment that they maintained a dividend of 31 cents, then that 31 cents this year might be quite powerful, but in the future it will be less powerful. So whatever bottle of wine you could afford today, in 10 years' time you won't be able to afford that bottle of wine because the price of the wine has gone up, but your 31 cents hasn't. And so it's really important to buy businesses that are able to retain at least a proportion of their profits and grow those profits over time so that the income grows. You need to put growth ahead of yield in order to ensure that your income grows in the future.
Roger, which sectors do you believe will grow strongly over the next decade?
Oh, that's a really tough question. I don't know the answer to that, quite frankly. We don't think about sectors, we think about individual businesses. There is no doubt that there'll be success in artificial intelligence, there'll be success in automation, there'll be terrific success, I think, in online platforms, but we look at individual businesses rather than sectors. So we think it's absolutely vital that investors think about whether the business in that sector has the ability to grow its profits, but more importantly, retain large amounts of those profits and reinvest it at high rates of return. I think the sectors that are the most challenged will be in the fossil fuel space, and I think there's potential for disruption in retail as well. So that'll be challenging for some businesses, but not all businesses. Many will survive.
Roger, many Australian investors tend to have investment portfolios that are heavily skewed towards Australian equities. It's a strategy that has probably worked out quite well for them the last 10, 20 years. Do you feel that's a sensible strategy moving forward?
No, there are a lot of themes and companies that you simply can't get access to on the ASX. There's a lot of disruption that's going on globally, and there'll be winners from that disruption, albeit difficult to pick who the winners are. But those winners tend to be overseas businesses, not domestic businesses. In fact, in many cases, the domestic business is the victim. So if you take supermarkets, for example, Aldi is succeeding at the expense of Woolies and Coles. If you look at media and social media, Google and Facebook are benefiting at the expense of Fairfax. And so there's a lot of disruption, there are a lot of companies that are going to win. Having said that, there are some excellent businesses in Australia, for example, in the healthcare space. There's some terrific businesses like Ramsay Healthcare and Healthscope, and I think over the next decade they'll do really well. But there's just more opportunity overseas. Beyond the 17% weighting to materials in Australia or resources and a 37% weighting to financials, if you want exposure to other businesses that are doing well, many of them are overseas.
What is the difference between a buy-side analyst and a sell-side analyst, and which is your firm?
So we're buy-side. We're buying shares for our portfolios through brokers who are sell-side. So a sell-side analyst is an analyst that works for a broker and is developing research to give to the broker, and the broker then sells that research, if you like, or sells the thesis or the investment idea to a client. We're the client, so we're on the buy side and the brokers are on the sell side. The big difference, of course, is that the broker is seeking to generate revenue income from transactions. We're generating returns from investment returns, so our goal is to generate high investment returns. So we don't buy and sell everything, and we want to transact as little as possible. The motivations are different. They're both valid, they're just different. It's helpful to know what research you're looking at, because sometimes there are conflicts.
So in terms of that research, would it be fair to say that the weighting you put on the sell-side research is not as high as your own buy-side research that you do?
We make investment decisions based on our own research, but we are very interested in what the market thinks about the companies that we're interested in. So to that extent, the research is very valuable. We don't really pay much attention to the buy, sell or hold recommendation that's attached to that research, but we are interested in the insights that the research offers.
And Roger, there have been many regulatory changes in our industry, in the advice piece in particular, over the last 10 years. How do you see that playing out for our industry, and also as well, how does that relate to you on the investment side and where we fit into your piece?
Yeah, there's a Pandora's box of changes that have already been legislated, and obviously a lot more to come, with a particular focus on ensuring that the client is put first. It's not going to be a problem for advisors that put clients first. You guys do a great job and you care about outcomes for clients. There is, I think, more complexity in financial markets today, and so it's really difficult for investors. I can't imagine investing on my own without a team of people and without the very broad and deep investment sources that we have. To be able to do that on my own from home, quite frankly, would be impossible. So the need, I think, for good advice is increasing, but that legislation means you have to be on the side of those advisors who are already doing the right thing by their clients, because those that aren't are going to be finding that they have to move on, and that's going to be very disruptive for their clients.
Roger, on the investment front, you're very much about buying businesses and holding good quality businesses. If you knew the ASX was about to close for the next 10 years, yes, are there any businesses that exist today that you would like to buy before that?
Oh, absolutely. If you asked me 5 years or 3 years, they would be different, but 10 is a very safe period of time. And by that I mean, I think within the next 10 years, there's a very real risk of some sort of decline in the market, or a correction, or, I don't want to use that word because it conjures up all sorts of fears, but you should see that as an opportunity. So in answer to your question, over 10 years, knowing that could happen to the prices, I think businesses like Reece, ARB, CSL, Cochlear, probably the banks, there'll be an opportunity over the next 10 years to buy them cheaply, I think. There's some businesses that I think are going to do extraordinarily well. I think REA will do incredibly well in the near term. If the property market declines, it'll probably have a tougher time, but then come out of that making even more money. So there's a lot of good opportunities in the marketplace. There's some of the best ones.
Thank you.
Pleasure.
Thanks, Roger.
No problem. Thank you again, Fraser.
No worries.
Thanks, Tom.
Thank you.